I'm Kenny Ezeji-Okoye, and this is reInvent. This week, I'm lucky to be joined by Morgan McKenney, the CEO of Provenance Blockchain Foundation, someone who has been pioneering digital banking solutions for the better part of the last 2 decades. In this episode, Morgan shares her views on why open systems will win out over closed ones, even in highly regulated and highly sensitive areas like financial services. We also speak about the benefits of building a custom blockchain with the Cosmos SDK, as opposed to deploying on another Layer 1 platform like Ethereum, and how an active and engaged ecosystem is a better competitive moat than IP protection. We also dive into the details of how traditional financial services can be improved by moving on-chain. With a background in computer science as well as an MBA from Harvard, Morgan has spent her career at the intersection of technology and finance, living and working across the globe to deliver innovation at scale in a variety of leading institutions, including nearly 20 years as an executive at Citigroup, where she led 2 blockchain initiatives and was most recently the COO of their largest division, Global Consumer Banking, working closely with Jane Fraser, now Citigroup CEO. Following her time at Citi, Morgan took on an advisory role with Center, a consortium founded by Circle and Coinbase to provide standards and governance for USDC and other fiat-backed stablecoins. In her current role as the CEO of Provenance Blockchain Foundation, Morgan is responsible for driving the adoption and development of a public permissionless blockchain designed for regulated financial services. Now that might sound a little bit strange on the surface until you discover that Provenance is currently being leveraged by over 60 financial institutions and has supported over $12 billion of transactions across lending, payments, and marketplaces, including the streamlining of on-chain mortgages and home equity lines of credit, as well as the creation of a stablecoin issuance consortium made up entirely of FDIC-insured banks.
reInvent is brought to you by Millicent Labs, building the financial infrastructure of tomorrow, where the power of Web3 meets the simplicity of fiat. Learn more at millicent.io.
Morgan, thank you so much for joining me today. Fantastic to have you here. We were chatting a little bit in the pre-show about some different things we have in common, like being North Americans but living abroad, notably here in London, and a love for skiing.
Absolutely. Thanks so much, Kenny, for having me. I'm absolutely delighted to be here.
Yeah, it's really great to connect. I've followed you for a while and I've heard your journey before, and I find it absolutely fascinating that you kind of started computer science, moved into TradFi, and now you're running a major blockchain foundation. Could you tell us a little bit about your journey?
Yeah, it's, if we think about, I learned very early on about hubris of not adopting technology. And I was in my early 20s, starting off in my career. I was working for the world's second largest derivatives exchange. It was called LIFFE at the time, LIFFE, London International Financial Futures and Options Exchange. And it was proudly, killing it in terms of interest rate futures and really dominating its space. And all of a sudden comes an upstart electronic exchange that basically takes the open outcry pits. Some of you guys might have seen those pictures in Chicago and London. And replaced it with an electronic trading platform. And it was called Eurex, Deutsche Börse. And it took life's largest product and migrated it to electronic exchange in about 6 weeks or so. And that was a great early lesson about, the march of technology drums on. And it's only accelerated, of course. You have a supercomputer in your pocket. And now we have these decentralized systems that are truly disruptive across a range of industries, including financial services. So I learned early, and I gravitated at Citi towards a very operational and technology-driven business, which is called transaction banking. It's the unsexy part of banking that helps Fortune 500 companies operate around the world, make payments everywhere. Governments and banks also obviously need it to really move. It's the arteries of the financial system, move money. And it's a very innovative business at Citi. And so I had the privilege to really help drive the leadership through technology. And that led to, when I was running cross-border payments in 2016 at Citi, from 12 to 16, Bitcoin and blockchain were really first emerging kind of in public consciousness. And I said, this is a new rail. This is a new way to transfer value. Can we use it at Citi to help our customers? And that led to a blockchain project with NASDAQ, who was trying to stand up a private markets business on-chain, right? It has a huge public exchange, and it was experimenting with blockchain to really build out a private markets business. But you need the money bit, right? So if you're buying a security or selling a security, you want money in your bank account, right? Wherever you live, in the UK and Japan and the US. And so Citi partnered with NASDAQ and a fintech, by the way, on the West Coast to really help orchestrate digital money in a bank account and making that money available on the blockchain, a private blockchain at the time. Fast forward to Asia. I lived in the time machine that's Asia for 4 years, from 2016 to mid-2020. Again, it's mobile only. It's not mobile first. Obviously, young populations across a lot of parts of Asia. Regulators that are really encouraging innovation for, financial adaptation. And that led to a project with Alibaba and Ant. And Alibaba said, why does it take me, why do I have to spend all this time spooling up to make payments I know I already need to make a number of days in advance? And so we partnered at Citi with Alibaba and Ant, who has a big blockchain division. Ant runs Alipay, the payment system, and a key payment system in China, to really speed up instant business-to-business payments, high value, cross-border. And I'm told that solution is still processing very, very, very large numbers of transactions in terms of value. And they've brought in other banks into the solution. So, but each of those projects took 1.5 years of my life, in addition to the day job. This is institutional adoption is hard. It takes time. But after an amazing experience working for Jane Fraser on the consumer side to see how the other half of Citi lives, really decided it was now the time. If you fast forward to today, right, people know what an NFT is. They've heard about stablecoins. They've heard about different chains. They maybe know about a ledger hardware wallet when you think about digital security. And so we have a lot more tools in the toolkit now to really adopt blockchain in core businesses. So, if you're a fund manager, issuing funds on chain, as an example. If you're a mortgage provider, issuing mortgages on chain. So I call 2022 the first year where we have true institutional adoption of blockchain and financial services in core businesses, not fringe, not the small side of the business or, an experimental side of the business, but they're the core business. So long-winded intro. Sorry, Kene.
That's really interesting. And you mentioned there that when you were at Citi, the blockchain initiatives were private blockchains. And that's something that we generally see when these traditional institutions are experimenting with blockchain or implementing blockchain, that the private closed setup feels familiar and feels safe. And Provenance is doing something completely different. Can you explain how that came to be and what your thesis is behind that?
Yes. After implementing blockchain twice successfully at Citi with private chains, I think I would not have taken this role at Provenance if we were a private chain. I just think there isn't enough juice in private blockchains to warrant the effort, which is significant, to adopting blockchain. And what do I mean by that? I think if we think about the world's most valuable companies today, many of them are platforms, right? They're bringing buyers and sellers together, like an Amazon. They're allowing open innovation. If you think about Apple and the App Store, right? Really enabling a platform for a range of developers to build their wares, and that increases the value of the network. In my humble opinion, again, as we think about development of innovation, open innovation is really, really important. We are part of Cosmos SDK, right? So we are part of the Cosmos ecosystem, which for some of your listeners that might be less familiar, Cosmos allows you to stand up purpose-built blockchains for specific use cases, and we're purpose-built for regulated and institutional finance. What does that mean? That means data privacy. So your information, Kene, if you were getting a home equity line of credit, your address, your name, your national ID number, Social Security is not on chain, right? It is not published, all the validators. So the data privacy is really important. All of that happens off chain. What's put on chain is, think of it as a unique digital fingerprint that confirms that the underlying information without revealing the underlying information publicly, right? So that's really important. We're proof of stake, which allows for high throughput, et cetera. And so 2/3 of our code base of our chain is developed by the Cosmos ecosystem. Cosmos is one of the most active ecosystems out there of developers building capabilities. And what that means is, A, you don't have to hire a bunch of people internally within the walls of an organization to build, right? So B, anyone can come up and start using it. Again, that allows people not to have to kind of go through this filter. And most of financial services today is already highly permissioned, right? It goes through a bank or a non-bank financial institution. And so I really do view the upside of a more open and decentralized platform is really where we will end up. For certain spaces like money, we might need to, training wheels on the way to the future, right? We might need to have private and permissioned zones. And so, for instance, we have that for USDF, which is our bank minted tokenized deposit. It sits in a private permission zone for regulatory feasibility. But we support a whole bunch of regulated institutions that, if you're a mortgage originator, you have to have a license, right? And so you conform to those license requirements as you're doing your business. For Apollo, if they're issuing a private fund on Provenance, which they are, they need to go through the right accreditation, right, of offering this private fund. So we can still support regulated financial institutions because it's a new tech stack, right? Think of it as like cloud on steroids. So it's a new way for regulated institutions to get better services to their customers.
I really like the cloud on steroids analogy. I think that's great. And what you said about 2/3 of your tech stack was built by the community. Now, given that most of Provenance's tech stack is open source and some wasn't developed by yourself, that removes one of the moats in defensibility that a fintech or a startup business usually has, which is their IP. So what's the strategy or the thinking behind Provenance for going open source, and how do you defend your business model or even promote it?
Yeah, and we were originally, this was before my time, on Hyperledger. So originally established as a private permission chain. And the decision was made very wisely, in my humble opinion, to move into Cosmos in May of 2021. And that was for a lot of reasons. I mean, private permission chains are very expensive to maintain, right? And expensive to build, et cetera. And so we covered that a little bit. But what's our moat? Our moat is ecosystem. So meaning an ecosystem of asset originators and asset buyers, right? We're helping support the new digital factory of finance. That means this assembly line of issuing an asset, financial asset on chain, whether that's a mortgage, home equity line of credit, a fund, real estate asset, and then enabling those activities to happen more efficiently on chain downstream. So meaning the servicing of the mortgage, the financing, the securitization. So a lot of financial services is about risk transfer of an asset, right? A lending asset as an example. A lot of it is about making things more operationally easy to issue and manage, like private fund space, where everything's sitting in a lawyer's cupboard. Lots of stuff is done by email. There's spreadsheets like email harassing you for capital calls, et cetera. It's really, well, it's quote digital because it's over email. It's really not structured and easy in a digital wow experience for the investor. And so we've built out, because we have supported these $12 billion of assets, a range of originators and a range of asset buyers. And as we, increase the number of assets we have on chain, that brings in more buyers. If you have private funds, you bring in accredited investors. If you have infrastructure lending, you bring in pension funds and insurance. If you have loans, you bring in banks and credit unions, et cetera. So while other folks, it's not always about the tech, right? Tech is a key piece, but it's about legal frameworks. We have great legal experts in our ecosystem. We have an amazing set of VCs and institutional owners of Hash, our token, used to pay all fees and for governance. And they are introducing us to portfolio companies, et cetera. So and we have the digital money bit, right? USDF, which we feel is designed for reg feasibility. So the moat is created through the cultivation of the ecosystem and the focus on regulated institutional finance. I don't believe any other chain is spending all day, every day, thinking about how do you support regulated and institutional finance at scale.
I think you're probably right there, Morgan. That's an understatement, if anything. The ecosystem is a great way to look at it. You've solved the chicken or the egg, and that flywheel is really moving. And you've got, as you mentioned, Apollo. If some of the listeners don't know who Apollo is, massive private equity giant. You've also got Figure behind you, who people might not have heard of. Could you tell us a little bit about Figure Technologies?
Yes, absolutely. And Figure was established by Mike Hagney and June Oh, and Mike Hagney founded SoFi, a consumer credit fintech that has grown to be very large and important in consumer credit space. And Figure is a pioneer. They have, and Mike and June knew that banks would not be first in to adopt blockchain. So they said, okay, we will establish a fintech called Figure in 3 highly intermediated verticals: lending, marketplace, and payments, and showcase how you can use blockchain for business value with real customers. And so Figure has just done that. It has it's originating several $100 million of home equity lines of credit a month, as an example. That's a lot of loans in a digital wow process, right? A 5-minute application process for a consumer and money in your bank account in a few days, right? It really is. If you think about, any of your listeners who've applied for a HELOC, most of them have suffered pain. They've had to go through bank stores, filled out a lot of paperwork, waited some time. Think about mortgages in 5 days versus 45. And so Figure has helped build, as a fintech, digital wow, and basically really showcase. So, in their fund space, they have digital fund services. And that's why Apollo is issuing private funds on chain, and firms like Neuberger Berman and Hamilton Lane, et cetera, some very large brand names in asset management, harnessing this product that helps them issue these assets more efficiently and offer secondary liquidity to their customers down the road, their investors.
That's pretty incredible to have, I guess, the idea for the blockchain and then the realization that, every bank that understands the benefits is still going to want to be bank number 10 or 20 to adopt it, and nobody really wants to go first. And Figure is that first mover, really able to kickstart the ecosystem.
Absolutely. If you think about disruptive innovation, this is a real de-risker, because I'm not selling a vision. I'm selling something that's live, being used by real customers. It really is a powerful idea. And you kind of, in 4 years' time, got 2 for 1. You got a chain and, a very valuable fintech that continues to grow like gangbusters. And their Figure's white labeling their HELOC product to a range of providers like Home Point Mortgage, Movement Mortgage, et cetera, because that is such a digital wow process.
Oh, it's, I guess the bang for buck definitely comes through when you've built Figure into a pretty big business in its own right, as well as the growing ecosystem on Provenance. And something that I'm curious about on the Cosmos SDK when it comes to ecosystem is the Ethereum virtual machine, or the EVM, has a huge ecosystem of developers. On the Cosmos SDK, they use Cosmosm or WebAssembly smart contracts, which are probably more secure than Solidity. This is a bit of a technical hole I'm going down, sorry to the listeners who aren't that interested in smart contracts. But there's a lot more blockchain developers comfortable with Ethereum than there are with Cosmos. So has that affected your ecosystem flywheel at all?
So Ethereum is the OG, right, after Bitcoin, of course, and you're absolutely right, Kene has a huge ecosystem. I think one of the decision factors in moving on to Cosmos by the engineering team that is now at Provenance was really around interoperability. And so I mentioned earlier that Cosmos is built for, it enables you to stand up a blockchain optimized for a use case. And but it also has embedded interoperability across chains, which isn't a feature in Ethereum. Ethereum is more of a sprawling walled garden, right, where you're really kind of having to use the core platform framework, and there's no adaptability in that sense. And again, because of our space, we're focused on quality, not quantity, right? So we need institutional focused developers, and we've recently relaunched our Hash Grants program to encourage long-term engagement by developers. But these are dApps like privacy dApps and KYC AML, fiat on and off ramp, security, new use cases, et cetera. So I think for us, again, given we're a B2B framework, right, that then talks to Cs, we really wanted that institutional sort of focus. So the consumer endpoints of Ethereum are somewhat less relevant for us. And this purpose-built, programmable, customizable, interoperable blockchain ecosystem we felt was more appropriate for our use case, because we could really tailor it for financial services.
Yeah, and I think that the Cosmos Internet of Blockchains idea is pretty cool and allows for a lot of different use cases to live in the same ecosystem. Like you said, you can carve out a niche for regulated financial services, and then right beside you can have, hardcore DeFi, I suppose you'd say. Speaking of the grants program, how's that been picked up? And are there people who are interested in the intersection of regulated finance and blockchain? Because those don't always go that well together.
Yes, I mean, I'm biased coming from traditional financial services in many ways, but I think it's a fallacy to think that financial services at scale can happen in an unregulated context, meaning, tenets of knowing your customer, making sure they're not, this is moving money, in many cases, money for assets. Really the endpoint needs to be known and accredited, as not a sanctioned entity, not a money launderer, et cetera. So I think while DeFi use cases push the thinking about what's possible, probably, I think ultimately for real financial institutions to use blockchain, it needs to be in a regulated context, and that's where the money and the customers are. So I do think that's really important as we think about where the future is. And again, as I mentioned, private areas might be training wheels on the way to the future as we learn how to mitigate the risks differently, right? So meaning you can get your validators KYC'd through tokenomics, right? It's a different way of having them KYC'd rather than a fiat or mandate kind of thing. So the tactics you use to ensure security, ensure governance, ensure AML KYC are different, but the objectives are the same. And so we consider ourselves a public chain with standards and governance, and we're keeping adding to that as, given our core use case and customer. But and that's why we think banks are such an important part of digital money, right? Banks are where the majority of the deposits are. Banks have lending methods, right, that basically can use fractionalized reserves to, inject credit into the economy, which is really important for business growth. And so in our view, bank minted tokenized deposits are going to be one of the dominant forms of, quote, stable coin, right, that are fiat linked but backed by money in a bank account held by a regulated institution ultimately. So again, as we fast forward, this is, in my view, how it's going to go or shape down. And so continuing to work on public with standards and governance, I think, is really going to be the winning strategy.
Yeah, I think you're definitely right. And you touched on a couple of points there that are really interesting, that the bank deposits are where the majority of the customers and the majority of the money already exist. Here in the UK, I think 96% of the money in general circulation are held as commercial bank money. You've got these huge network effects of people and merchants that already accept bank deposits or electronic money here in the EU. And that's something that can really be built on top of without that much regulatory change. Not no regulatory change, but not that much. Another benefit is that more than one issuer can issue the same stablecoin, which today a lot of stablecoins are siloed. USDT isn't the same as USDC, for example. And with that being said, I would love to dive into the USDF consortium and how that was set up and how that's operating on Provenance.
Yes, and so USDF is exactly, as you mentioned, a collaborative coin, right? If you become a member and you need to be a bank, a regulated bank, to become a member of USDF consortium, you are effectively agreeing to accept USDF minted by another bank and credit your customer, right? So again, in my view, a collective coin allows for much greater and broader access, right? JP Morgan coin, no matter how big JP Morgan is, and as a bank, and of course it is big, it can only be, let's say, 15% of the customers, et cetera, right? So I think it's a breakthrough that is a collaborative coin accepted by other consortium member banks. Second is it's restricted in its distribution, meaning USDF can only go to an AML KYC'd wallet of another consortium member bank. That's also important. Again, it keeps the initiation points and the endpoints credentialed, right? Basically, meaning the bank knows its customer and has already done due diligence about it. So that's important. The third is, and the CEO, Rob Morgan of USDF Consortium, is announcing this shortly, is broadening adoption to banks participating with not having to commit to mint, right? Right now, there's 9 banks that have signed up and they've committed to mint. They're operating members. And USDF Consortium is broadening its membership category to help for advocacy, right? Because there is a lot of stablecoin legislation underway in the US in particular, and really getting that right is important, and enabling banks to participate in the digital economy is important. So we're excited about it. In my view, there'll be a range of digital money on chain, right? It is a really important factor in the overall equation working. If you think about getting a financial asset on chain, any financial asset has cash flows in or out, right? If it's a private fund, maybe there's capital calls. If it's a loan, there's repayments from the customer. If it's a a note, there might be coupon payments made, right, regularly. And once you get the financial asset on chain, you can program the money bit to really, really, really deeply automate the financial ecosystem to coordinate those payments through smart contract, right? Whenever the cash flows in or out of that financial asset are, even getting money markets digitized, money market funds, et cetera. So I think we'll see many different forms of money ultimately, but the majority, in my view, will need to be issued by regulated entities ultimately for trust.
Yeah, and I think that we've already seen, even on Ethereum and the other permissionless chains, that the most popular stablecoins are fiat-backed,
Definitely.
Or at least purport to be. The algorithmic stablecoins, the ones that have gotten really big, have ultimately failed, and crypto-collateralized stablecoins haven't worked as well as some people would have hoped that they did. So I think that there's really something to what you're doing with the USDF consortium. I've always said stablecoins are great, but until we're able to use different stablecoins from different issuers, it really does affect the user experience. If I can't buy my coffee with any stablecoin I have in my wallet because the coffee shop only accepts USDC, then either everyone accepts one issuer's stablecoin, which creates a lot of risk, or we end up with a kind of fractured society, which it isn't great.
Definitely. And payments already, it's very cultural, right, around the world, having lived around the world. And I know you're deep in payments and digital money space as well. It's just getting something for mass acceptance, right? I think I went on record 6 or 7 years ago that Bitcoin would not be a commercial payment currency, meaning something you use because there's just much better payment systems out there. And but in my view, you do need digital fiat on chain ultimately, right? Fiat is how people price the world. They know how much things cost, the value, et cetera. So connecting fiat issued natively on chain by a responsible provider, I think is the way that we will trend.
Yeah, and you mentioned regulation in the US, and we expect to see a lot more coming out there. What's next for Provenance?
We're excited because I view this as building the bridge across Death Valley to get to a future that is fairly clear, with a significant portion of financial services being natively issued on chain and then going down that digital factory on chain, right, for business value and customer value. But the way you get across Death Valley is slat by slat. You build that bridge slat by slat, which means asset class by asset class. And we're starting with the high friction assets, right? The ones that are opaque, hard, like private assets. They're operationally intensive to issue and manage. The agreements are sitting in lawyers' cupboards. You can't price the asset. There's limited or no liquidity as a result, et cetera. And lending, right? Some of these high friction lending spaces like mortgages, if any of your listeners have gotten a mortgage, I doubt they would say it was an amazing wow experience. So, there's some other many interesting use cases we're pursuing. One is in the receivables space. This is big. This is, basically, a buyer agreeing to buy something large from a seller and bringing in financing so that the seller can get paid earlier than the terms using the buyer's good credit. In many instances, that's one big use case where you can certify the invoice as legitimate by the buyer and therefore bring in financing and program the money appropriately. Distressed assets, obviously, economic growth is challenged in many places in the world today, and there are many bankruptcies, high-flying ones in crypto land, of course, but obviously beyond, and the transparency of bankruptcy claims, the ability to trade those claims, because people have very different views on what a distressed asset is worth. Spaces like infrastructure lending, as another example. These are high-quality loans, but only really banks can hold those loans. This is for bridges and roads and power plants, but these are good returning assets, low probability of default. If you tokenize those assets, you really enable the cash flow exposure to be provided to many other people other than banks, so you can address some of the funding gap in infrastructure lending. And these are just a few examples. So we're delighted and excited to be working with very interesting fintechs as well as large players trying to improve their business.
I'm really excited to see what's next for Provenance. I've been following the ecosystem for a long time. I love the Cosmos ecosystem, really like what Provenance is building on the intersection of regulated finance and public blockchain. Thanks so much for joining me today. Is there anything else that you want to add or direct some of our listeners to?
Well, I'll just reiterate my thanks, Kene. It's been a pleasure to meet you, and you're doing such exciting things. So I can't wait to chat more about that. But folks should find us on LinkedIn, Provenance Blockchain Foundation, or Twitter, or connect with me personally. This is the coalition of the willing and the able, meaning finding folks that are really passionate about putting their flows on blockchain. If you're one of those folks, we'd of course love to speak with you. If you're a developer that want to build capabilities, we'd love to speak with you. So really it's collaboration PhD in this neck of the woods. So of folks that are highly motivated that want to help lead this future. This is really crowdsourcing the future of finance. So it's super exciting. We want a lot of diversity of thought and input in that development. And so, we'd be delighted to chat if any of this piqued your interest.
Yeah, well said. I think the open ecosystem is fantastic for diversity, and financial services is definitely an industry that could use some more diverse thought and inputs, and really excited to see where Provenance goes from here. Thanks so much for joining me today, Morgan.
Thanks, Kene. Thank you.
reInvent is brought to you by Millicent Labs, building the financial infrastructure of tomorrow, where the power of Web3 meets the simplicity of fiat. Learn more at millicent.io.